National Association of Realtors sounding the alarm. If the economy continues to show strength and the Federal Reserve hikes rates again, we could see 8% mortgage rates. Our next guest says that is bad news for housing demand.
Oh, mortgage rates are now the highest they've been in more than 2 decades.
Mortgage rates topping 7% this week, hitting levels that we haven't seen in more than 2 decades.
What in the world is happening with the housing market these days? It's like we can't go a single day without hearing about skyrocketing rates and plummeting affordability. If you're someone caught up in the chaos of trying to buy or sell in today's market, my heart goes out to you. And as a real estate agent, if you are working with me, I usually do my best to help you cope with the madness. But at the same time, I truly empathize with the nightmare and frustration you must be going through. I mean, how else should you feel? Imagine you're someone who puts in 40 to 50 hours a week at your job, making a solid income, doing a great job at providing for your family, has a great credit score, good amount of savings, and right when you decide to buy your very well-deserved first home for you and your family, you find out that today first-time home buyers need to earn 13% more than a year ago to afford the typical US starter home. Yep, you heard it right. Redfin just reported that to afford the typical US starter home, a first-time home buyer needs to earn around $64,500 per year, which is $7,200 higher than the last year. That's because of the combo of higher mortgage rates and home prices. The way Redfin determines what a starter home is by considering the bottom third of the market in terms of sales price. Now, of course, depending on which state and city you live in, the amount you will need to earn will differ. For example, if you live in Sacramento County, in June of this year, the median sold price for existing single-family homes was reported $530,000. Assuming that you put 20% in down payment and only 30% of your monthly income is going towards the mortgage payment, your annual income should be at around $112,000. That's actually less than what you would have to earn the previous year, given that the median sold price declined by 5.4% compared to June 2022. But still, even though it's less, it still seems a lot. I mean, ask yourself, how many people do you personally know who are earning that kind of a salary? Not many, right? Believe it or not, San Francisco is another city where starter home buyers need less income than they did a year ago, along with Austin and Phoenix. A home buyer in San Francisco must earn $241,200 to afford the typical starter home, down 4.5% or $11,300 from a year ago. And as I said earlier, that's assuming you put 20% in down payment and only 30% of your income is going towards mortgage payment. But something tells me that 30% might not be enough. When Redfin initially published this article, it referenced the mortgage rate in June, which stood at 6.7%. Since then, there has been a significant increase in the mortgage rates. As we record this video, the rate currently stands at 7.4%. So if adjusted to today's rate, first-time home buyer must earn now more than 13% compared to a year ago to afford starter home. So instead of 2 jobs, you might need a third one, which is very discouraging news to the average hardworking American who lives in a world where owning a home has become a luxury. Needless to say that affording a house today is extremely challenging. US housing affordability has now hit a 40-year low, meaning that the last time when it was this hard to purchase a home was back in 1980s. In fact, affording a house is so challenging nowadays that in order to grapple with the crisis effectively, some are proposing to adopt the idea of letting more Americans own their home without buying the land underneath it. Instead of owning the land, a homeowner could simply lease it. This model is widely adopted in commercial real estate. Many of the commercial buildings in urban areas sit on land that is being rented by the business owners. And some are asking, why couldn't we do the same for the residential real estate? Those proposing this model argue that the housing prices could reduce by 25 to 30%, allowing more people to purchase a home. The question is, would home buyers be willing to part with the traditional notion of home ownership? Comment below in the comment section if you would buy a house that's cheaper by 25%, but you don't get to own the land that it sits on. Now, let's talk about the mortgage rates and how we got here. You see, everything was somewhat quiet on the economic and market front prior to August 9th. I mean, that's not to say there were no fluctuations. There was. After all, it's earnings seasons and many companies were reporting poor results. On top of that, the credit rating agency Moody's downgraded a bunch of US banks, which had an impact on the market. But then on August 9, inflation data for July was reported, which came in at 3.2% compared with 3% in June. For the first time in a year, inflation actually ticked up. Although inflation is far below than the previous year's levels, which was 9.1%, it still has ways to go to reach Fed's 2% target. A few days later came out retail sales data coming in at 0.7% for July, surpassing the 0.4% forecast and posting the biggest increase in 6 months. You see, under normal circumstances, this is actually a good indicator that the economy is in good shape. But when inflation is running hot, Data like this makes the Fed very nervous because remember, the whole point of fighting inflation by raising rates is to make it hard for the consumers to spend. And judging by the retail sales data, it looks like they're spending quite a bit. After inflation rate for June was reported at 3% and the Federal Reserve implemented a rate hike in July, there was a widespread belief that this would mark the conclusion of rate hikes. Investors speculated that the Federal Reserve would maintain elevated rates without any additional hikes for the rest of the year, and by the first or second quarter of 2024, the Federal Reserve would initiate rate cuts. On August 11, traders saw an 89% chance that the central bank would hold rates steady at its next meeting in September. But then on August 15, Fed's meeting minutes for July were released and it hit below the belt. The minutes showed that the Federal Reserve is keeping an open mind about future rate hikes. Most participants continue to see significant upside risks to inflation, which could require further tightening of monetary policy. This message sent a shockwave across the markets. On Thursday, August 17, the 10-year Treasury yield hit the highest level since 2008, reaching 4.3%. While some are saying that the yields are up due to the economy's strength, and while that may be true, I also believe that the markets are pricing in another potential rate hike in September. As I mentioned this before in my previous videos, when bond yields rise, that puts pressure on mortgage rates because mortgage rates are typically based on the yields of the long-term government bonds. When the yields on these bonds rise, mortgage rates also have to increase in order to remain competitive for investors' money, and this is where we are today. The 30-year fixed has reached as high as 7.4%. There were reports that some buyers were already receiving mortgage quotes at 8%. Because of rising mortgage rates, builder confidence, which recently thrives on the lack of resale inventory, fell by 6 points according to the National Association of Home Builders. We still don't have the data to see how this recent rate increase affected mortgage applications, but I suspect it may not be good. So if you are a buyer in today's market, these are some of the challenges you are facing today. And my best advice for you, if you're still determined to purchase in today's market, is make sure your finances and credit history are in good shape. The better position you are from that perspective, the more chances you have to get a better mortgage rate. Shop around. I know you heard this one before, but you'll be surprised to see how rates and fees may vary between different lenders. Also, ask your agent about assumable loans. During the 1980s, when mortgage rates were 18%, assumable loans were the only thing that kept the housing market moving forward. Perhaps this could be an option for you today. That's all I have for you today. If you watched to the end, thank you for your time. If you live in Northern California and need help with anything that's housing related, contact us directly. Our contact info is in the description below. See you next time.